Okay, today, I think we can say it, was just a bad day for the markets. Here in this video, I will put into context everything that happened today and what you need to know. We do also have some big economic data coming out tomorrow that will help further drive markets higher or lower. As I have called for recently, this 10% correction that I see coming, I made this call on October 21st. For a few days there, it looked like we weren't going to see any downside. Well, we've now fallen 3% exactly from our all-time highs. So as per my expectations, up to a 7% decline from here could be possible, and I'll explain why in this video. So I have to give it up to this earnings season. Yes, the bar was low. It's not like we had high expectations for this earnings season, but all things created equal, big tech is beating. Companies in aggregate are beating estimates. I don't really think the concern at this point is about earnings. Now, Wall Street's going to be a little jumpy, a little concerned about earnings until we get NVIDIA earnings. What we've heard so far from companies is actually very supportive of NVIDIA. So should you worry about earnings at this point? No, we've gotten all of our big tech stocks out the way. Besides NVIDIA, I highly doubt NVIDIA is going to give us disappointing numbers, but again, in a weird way, you kind of needed earnings, at least from big tech, to get out of the way before we seen larger corrective downside. You can think about this in a couple of ways. Even though earnings were good, the good catalyst that we were expecting is over with. It's kind of like when Apple or NVIDIA holds some kind of AI event. WWDC, for an example, or NVIDIA's specific events. If we don't really get anything that's groundbreaking out of those events, those stocks sell off after those events. It's a typical buy the rumor, sell the news event. Now, even if you're not seeing necessarily a sell the news event with earnings, because some earnings are good, like Google's good, Google went up, right? Amazon was good today and after hours, Amazon stock went up. It's Apple, it's Microsoft, some of these companies that have a little more shaky numbers that are actually falling because they were priced for perfection. Long story short, without getting into the nitty gritty of everything here with earnings season, it's kind of like okay, they were okay earnings. They weren't great, weren't terrible across the board. A lot of companies are doing okay. What else do we have to look forward to? What else do we have to look forward to is the concern at this point. It is economic data. It is the Fed. It is the election, in which I think a lot of people are forgetting. On Thursday of next week, 2 days after the election, which is on Tuesday, we have a Fed meeting on November 7th. And who knows what to expect from the Fed? Are they going to hold the same stance that they held previously? Are they going to change it up and become a little bit more hawkish? These are things I think the markets will have concerns about. Kurt S. Altricker writes on X, tomorrow is the most important jobs report of your life. So read this thread. He says the stakes are sky high for tomorrow's jobs report, and here's why it matters so much to the markets. It could determine what the Fed does next, and that decision will ripple through every asset class. And I think that's pretty accurate. If we have some jaw-dropping jobs report, it's not going to prompt much of easing from the Fed. And I guess to that same note, if we have a bad jobs report, it's going to be like, what the hell happened? Because ADP was good and all these other smaller employment metrics have also come in good in recent weeks. Currently, the markets are pricing in a 93.4% chance of a Fed rate cut next week on November 7th. So that seems like a certainty. For December 18th, we're pricing in 71.5% chance of another 25 basis point cut. So I don't think the jobs report's necessarily going to derail the next two cuts, but it will make a big difference for 2025. Or in actuality, I don't think it's going to make a difference for 2025 necessarily with just one jobs report, but the markets will think it will, right? Is one jobs report going to totally alter the Fed's perspective on what they need to do with federal funds rates, which is clearly they've stated they want to bring them down? No, it's not going to change anything. But Wall Street might say, oh yeah, that means less Fed easing in 2025. Again, if next month's jobs report is weak, then Wall Street's going to price in more cuts again, right? And that's just kind of how emotions work in pricing Fed policy in equities. As far as the data coming out tomorrow morning, we have non-farm payrolls expecting only 180,000. That is for the forecast. The consensus is only 113,000. So you are pretty well on the low side of what we should expect, given the ADP employment change just came out yesterday that showed 233,000 job ads. Like, I think we kind of have low expectations for tomorrow. With that said, the unemployment rate is actually expected to rise from 4.1% to 4.2%. Now, it's all about the decimal here, of course. So if you get a unemployment number that comes in at 4.06, that gets rounded up to 4.1. If you get an unemployment rate that comes in at, 4.16, right, that's going to get rounded up to 4.2. And there's a big difference between those actual numbers, right, in the rounding error. There can be 10 basis points, technically 9 basis points between a 4.1% or 4.2%, right? You could be on the low side of 4.2%, or you could be on the high side of 4.2%. And honestly, at this point, getting a little bit higher of an unemployment rate might not be the worst thing for markets, considering bond yields just continue to move higher. Now, 10-year Treasury yields today were basically unchanged. Tomorrow, you also get some secondary data like average hourly earnings month over month, year over year, participation rate, U6 unemployment rate, smaller things, but really the markets care about that headline non-farms number and the unemployment rate. ISM manufacturing PMIs, though, is a separate data point that will be coming out. You're expecting 47.6. Last month was 47.2. So you are expecting things to get a little bit better, and Wall Street will be paying attention to the employment component of manufacturing, as well as construction spending, new orders, and prices paid. You're expecting a boost or a jump up in all of these components in the report tomorrow. Now, today we did get some economic data. Core PC price index month over month came in exactly in line with expectations. So did personal income. PC came in at 0.3% month over month. Personal income came in at 0.3% month over month. Personal spending was expected at 0.4%. It actually came in at 0.5%, but not as good as the headline number looks, considering last month we were at 0.2% and got revised up to 0.3%. So all things equal, the data pretty much came perfectly in line with expectations today. Initial jobless claims came in lower than expected at 216,000 versus estimates of 230,000. And I think really at this point, the data is coming in a little too good, right? It's pushing back some of those Fed easing expectations. Although I'm in the camp of you want to see the strongest economy possible, no matter if that means the Fed's not going to cut rates as much as expected. Who gives a crap? If you have a strong economy, earnings are going to expand. You're going to get broader earnings breadth and growth in our markets. And that's the way that you will see the famous, at this point, broadening out trade of our markets, right? It's not just if the Fed cuts rates. Theoretically, you would want the economy to stay as good as possible for as long as possible. So I don't really think I don't want to say it doesn't matter, but you can really draw different narratives from the same data point. Like the data we get tomorrow, you could make a strong argument that that's good for markets if the unemployment rate stays low or we get a big jobs beat, because that's good, right? The economy's good, labor market's good. What's not to love there? Then you can also make the argument that that's bad because the Fed's not going to be cutting rates. It's just what's good to you, what's bad to you. I'll obviously share tomorrow, what I think's good and bad. But really, for my correction call at this point, it has very little to do with the economic data, because I don't think the economic data at this point is what markets are really focused on. That said, you did get the Chicago PMIs today that came in at 41.6 versus estimates of 47. So that pretty pretty largely missed expectations. Now, some news did come out today that boosted commodity prices, specifically oil and gold. It is this: Iran is preparing a major retaliatory strike from Iraq within days. Now, Seth Golden on X, a bull that I like to reference here on this channel a lot, he says, "This is the only thing that happened today. You can attach any narrative you desire to attach to today's price action, but this is likely the only thing actually and finally being realized. Enjoy your day putting capital to work, or worry your day listening to fearful narratives." And he shares this post from October 1st. He says, "Overbought conditions are piling up. S&P 500 is currently greater than 5% above its 50-day moving average and 10% above its 200-day moving average. During the nearly 2-year-long bull market, every single time such conditions have been met, the S&P has checked back to its upward sloping 50-day moving average. Just a matter of when, not if. History informs the best approach is to add exposure during consolidation. History informs the worst approach is to sell into consolidation, hoping to buy back lower. Be on the right side of history." And that's exactly what happened today. Markets decisively broke below its 20-day moving average, a level in which we have been finding support at for 1, 2, 3, 4, 5, 6 trading days in a row. Almost every day we bounce at this 20-day moving average. Today you gap down under that 20-day moving average. It looks like you found some buyers that did step in at that 50-day moving average, although we were down almost 2%. Like, we didn't technically touch the 50-day moving average, just came close because we were already down 2%. And again, this is the worst Halloween we have seen for stocks since at least 1985. Like, this is a really bad Halloween. Now, there's a lot of different reasons for this, as we've discussed. Question is, do we bounce at the 50-day moving average or do we not? It's actually interesting because the last 2 times we broke under the 50-day moving average, we broke under the 50-day moving average. Like, you did not bounce right at the 50-day moving average. You actually fell below the 50-day. Here's the thing, though. The drop only lasted a couple of days. And with the setup that I am seeing, I only think the drop will last a couple of days. I don't think this is the start of a larger bear market. I don't think this is the start to be overly, concerned about markets. Just there's some fear factors that markets are contending with. Again, the data is coming in really good, pushes back the Fed's, cutting narrative. Again, you can make an argument, a very strong argument, in which I side with this. That's actually a good thing. The economy is doing well. You want that to happen, right? You don't want to go into a recession. You don't want to get into an even slower growth environment. That's ultimately way worse than for stocks, rather than the Fed, being able to cut rates at a slower pace. Okay, so hopefully that makes some sense. But you also have the election. And it's not really just the election. It really is the probability of a contested election. Something like Al Gore and Bush back in 2000, where you don't know who the president's going to be for a month. It has to go through the court system, and that would be a huge problem for stocks. You would likely see liquidity start to dry up a bit, and markets would react very negatively to that. Now, my personal political expectations are going to be different than yours. I actually don't think we're going to see a month-long election, being contested. Honestly, I think it's going to be over pretty fast, because I think the reality of the situation is you're probably going to see one candidate beat handsomely, and we're probably going to know within a day or two who the president is going to be. But if there is a period of uncertainty on that, liquidity will start to dry up and markets will move lower, even if it's 24 hours, 48 hours. The election's on Tuesday. If we don't know who the president is by Wednesday night-ish, markets are going to start pricing in very negative things for that. Should they? Is that logical, or is that reasonable? No, I don't think so. But that's just how Wall Street is operating. Now, again, back to the point that I made earlier in this video, we've all been waiting for big tech earnings specifically to really justify this rally that we've seen. And while earnings are justifying that rally, it's like the good catalyst is over with. And now all we really have to look forward to is presumed negative catalyst, like the election and like stronger than expected economic data. So it kind of takes away some of that market support in a weird way. Unless, of course, these big tech stocks were to have Nvidia-like earnings, something huge, then that would have obviously fueled markets to go higher, and I think that would have created more upward momentum. But that didn't happen. Earnings just kind of across the board met expectations and slightly beat expectations for a couple companies. Mark Newton with Fundstrat says Apple held prior highs and pulled back in a three-wave corrective move ahead of earnings. This pattern does not look like the start of a larger decline for Apple and makes this attractive at or near between 221 and 223. While the breadth and momentum of the broader tape warrants short-term concern for November, this won't be as easy as many bears believe, with a few key tech earnings to finish out the week. My short-term cycle suggests a turn October 31st or November 1st, which very well could be a low. Regardless, this stock remains one of, if not the most important stocks within the SPX to keep a close eye on, given its concentration within the S&P, QQQ, and tech. And if you are in the bull camp category, if you're not looking for stocks to go through a larger correction and just you keep buying, you want to continue to buy these higher prices, you don't want to discount in other terms, here's some good news. Good news is the Fear and Greed Index has sharply turned lower today. Now you're at 44, which is in fear territory. Typically, when you start to get in fear territory, corrections tend to slow down. I think some of this has to do with the VIX, not actual carnage or pain we've seen in markets. So, that doesn't necessarily mean that markets are done selling, but it's a good sign that a decent amount of the selling has already been done. And to that point, I do think after we know who the president will be, whoever it is, as long as there's not some kind of sweep with the Senate, House, and president, then you're probably going to get that end of the year rally from my perspective, especially if we do go through a larger pullback here. 2024, albeit great year. Today was the worst October since 1985. This is the biggest year-to-date gain through October in an election year since 1936. This basically just means stocks tend to sell off before the election, even if you're up a lot, right? If you're up a lot, you tend to get a correction before the election. That brings down the return heading into the election, and then you power higher throughout, November and December, right? We'll see if we get that, but so far, markets still look really strong. Jeff Winiger says this is a warning signal from the Conference Board's survey question on future stock market returns, which just touched an all-time high in 37 years of records. More people say stocks will increase than the combined number who say they will decrease or stay the same. The theory, the general public is most confident about stocks at precisely the wrong time. Heisenberg writes on X, the SPX is giving him a deja vu that things look eerily similar with this uptrend. You break the uptrend and you go lower, right? You go quite a bit lower. Now, if you actually chart this out, you have a large drawdown, you have a smaller drawdown, and then this could be an even smaller drawdown. It just depends clearly, how things go. This was a 10% correction. This was about a 6% correction here in early September, 5-6% or so. What's this one going to be? Is it going to only be a 3% correction, or is it going to be a larger correction? He does reference here that markets broke support, and that's when the real pain started. Whereas perhaps in this 5% correction or so, you didn't break as much support. I do think the big question at this point is, do we hold that support again at the 50-day moving average, or do we fall below that? And typically when you do hit this 50-day moving average, you do tend to fall below that, right? but only momentarily. It doesn't tend to be a longer term sell-off. At least not in recent history. So in conclusion, you have big tech earnings that, yes, by and large are good, but that good catalyst we've all been waiting for is now out of the way. And Wall Street doesn't really care about what happened yesterday. It's all about looking ahead. So ask yourself, what do we have to look forward to now? Presumably good economic data, saying less cuts from the Fed. Depending on which way you look at that, again, that can be seen as a negative, can be seen as a positive, but markets are going to look at that as a negative. And you have the election. Both of these things presumably are not great for markets. Now, you do have NVIDIA earnings that could come in and save the day, but that's not until later November anyways. So election, good economic data. Never thought I would say that before, but good economic data. Two things that could cause more fear in markets. And that's what I think at this point is going to push stocks lower. I actually think earnings were kind of supportive of the markets in a weird way. Like they could have been much worse. So these are just my thoughts. Let me know what you think about this information down below in the comment section. Again, we are already down 3% from all-time highs, almost exactly. A 10% correction would put you down to about that 200-day moving average at about 530, technically like 527 or so, but call it 530. You likely get some support, in my personal opinion. That would be down about 9.5%, so close enough to my 10% correction call. Is that a guarantee though? Absolutely not. I'm not a financial advisor, I'm not a fortune teller, and I'm not a wizard, so come to your own conclusions. But again, let me know what you think down below in the comment section. Have a great rest of your day, and I will see you in the next one.